they have always had at least a 10% dividend yield. They sort of pay between 35 cents and 45 cents. They pay a variable dividend yield based on what they make. They make X amount, they pay 75% of it in tax advantage. This dividend they declared yesterday is 100% return on capital, 100% tax deferred. So that's always nice. Um, they'll probably will pay a buck 45 this year, buck 50. If oil's going to be a little better, maybe, and natural gas might be a little lower because natural gas is now in the 280s. It's very hard to figure out, these commodity swings. But these guys have flat production. They have very low decline rates in their fields. And it was very hard to find 10% yields. Now, when the stock dipped to 11 and change, I came on and you had a 13% yield, 12, 13% yield. I pounded the table on it because it was crazy. Last year when the oil stocks got sort of, they didn't get crushed, but they definitely had a bad period when AI mania was in full bloom for sure. And oil was dropping from the 70s to the 50s, if you remember, throughout last year. So it did have a bad period, but they're partially hedged, and that helps mitigate some of the net commodity swings to them. And it's just if you need a 10% dividend yield, you're not going to get much growth here because they don't preserve any capital with which to grow. And when they do deals, they do them overnight at 8% discounts, which ticks me off to no end. And it kind of takes the stock down that 8%. So they have to issue shares. So the revenue and the production per share stays flat while they grow production and add cash flow to EBITDA cash flow, and the dividend per share tends to same. It's the same as it was 10 years ago, even though the business is 10 times bigger with the significant roll up they're doing. The royalty space, Bob, is actually a pretty good space. I have some private equity royalty business in the Utica Shale, and it's done excellent for me. It's you get you're top in line for credit as a creditor. You get the royalty payments off the gross revenue. There's not a lot of hits to it between then. You don't have any capital spending. You have very obviously very high profit margins. All it is like SG&A. You don't have to contribute to producing the barrels. There's no cost, so it's a very good business model. So the way you get paid here is in your average oil stock today, you might be getting a 5% dividend yield, and this dividend yield's always been double digits. So the other guys can grow 5 or 10% a year and give you their 3 or 4% dividend yield. These guys, they really don't preserve any capital to grow organically. So they pay all out. They repay debt with 25% of their cash flow because they use debt leverage to buy other royalties, and then they pay 75% out. So it just depends upon the quarterly cash flow. But the number, it's been surprisingly long between 35 and 45 cents. They might have gone up to 50 cents or 55 cents when natural gas went up to $6, $8 back a couple of years ago. But even that normalizes as the commodity price normalizes. So you never pay for that. So, but it still has a 10% yield today. It's about the highest. This is about as high as I would buy the stock. And if it does have direct exposure to the commodity prices, unlike the pipelines, which you and I own. And, I have a much bigger part of my income portfolio in the MLPs. But it's it's a solid business, decently run. And, if you need a legitimate 10% yield and you believe oil and gas prices are around normal at, $60 or $65 and $3, I think it's a very sustainable double-digit dividend yield in here. So that they reported yesterday, the numbers were really solid. The production was up and above expectations. And here's an example of a company. It's a royalty company, and they said they expect flat production this year with no incremental capital invested. And as you know, the sort of the field decline rates of existing production could be mid-single digits. So normally you would expect a royalty business, if it didn't have any growth capital to invest, to decline low to mid-single digits in its production. But these guys forecasted last year was a record. This year, the fourth quarter was a record, and they forecasted a flat year in production.